Welcome back to the deep dive. So picture this. You're the lead auditor, maybe based in New York,
Okay.
and your client, a huge multinational company, subsidiaries everywhere, Beirut, Dubai,
Yeah.
Singapore, you name it.
Right. A global footprint.
Exactly. So how on earth do you sign off on the financials for this massive thing, spread across continents, different rules, different cultures?
Yeah, it's a huge challenge.
That's what we're digging into today, the whole complex world of auditing group financial statements.
It's definitely intricate.
Our goal here is to, break it down, make sense of it. We want to look at the key players, like the group engagement partner, the component auditors.
Understand their roles, their responsibilities.
Yeah, and the challenge is, especially when you're consolidating reports from all over the globe, it's fundamental to how big business works, really.
It truly is.
Now, before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, examples, explanations, it's all derived from the great accounting resources over at farhatlectures.com.
Really comprehensive stuff.
Absolutely. So
Yeah.
whether you're an accounting student prepping for the CPA exam or already a professional, you should check out the website. They've got additional practice questions, video lectures, detailed support, great for reinforcing today's topic.
Definitely worth a look.
And a special thanks to Professor Farhat for providing this valuable material.
Okay, so where do we start?
Right. Let's start at the beginning. What are group financial statements?
Ah,
You hear that term. Basically, think consolidated financial statements, yeah.
exactly. They're financial statements that pull together the financial info from lots of different parts, different entities.
As if it were one single company.
Precisely. Like, the example from the source is good. Farhat Accounting in New York City auditing Adam Shipping Inc. That's the parent company based in the U.S.
Okay.
But Adam Shipping Inc. isn't just in the U.S. Maybe it owns, say, Lebanese Shipping Inc. in Beirut.
A foreign subsidiary.
Right. Or it could have other bits in Dubai or Egypt. These are all components of the Adam Shipping Group. And investors, stakeholders, they need to see the whole picture, right? So you need to stitch all these pieces together.
Into one set of financials.
Yeah. One comprehensive set.
Which brings us straight back to that big challenge. How does the New York auditor get comfortable with the numbers coming out of Beirut or Dubai? Different languages, maybe different accounting rules.
Different legal systems, too. It's complex. And that's where the group engagement partner, the GEP, comes in.
Ah, the central figure. So the GEP is the main partner responsible, like Farhat Accounting in our example.
Exactly. That's the principal partner. And their responsibility is, well, it's immense.
How so?
The GEP is on the hook for the entire group audit, the whole performance, and crucially, that final audit report on the consolidated statements.
So they're signing off on work potentially done thousands of miles away.
Yes. They're essentially staking their firm's reputation, maybe their own career, on it. They set the strategy. They evaluate all the evidence.
All of it, even from other auditors.
All of it. They have to draw the conclusion and issue the opinion. The source uses phrases like, I have the final say, and the buck stops with me. It really does. For public companies, you'll often hear this called the principal partner.
Okay, the buck stops with me. That paints a picture. So given that huge responsibility, let's break down the players. What exactly is a component?
Good question. A component is basically any entity within the group structure. Could be a subsidiary like Lebanese Shipping Inc.
Okay.
Or a joint venture, maybe even an investment where they use the equity method. Any part where management prepares separate financials that then get rolled up, consolidated into the group statement.
Right. And I think you mentioned something about significant components. What makes one significant?
Yeah, that's a really key distinction. A component is significant for basically two main reasons.
Okay.
One, it's financially significant, just
Yeah.
big, a large chunk of the group's assets or revenue.
Makes sense. Size matters.
It does. Or two, it might not be huge financially, but it has the potential to contain significant risks of material misstatement.
Ah, so risk is the other factor, like a small unit doing something really complex or risky.
Exactly. Maybe a small subsidiary handles all the group's complex derivatives or something. That risk makes it significant, even if it's small.
And why does this significant label matter so much?
Because significant components must be audited. No skipping that. Either the GEP audits it directly, or they use a component auditor.
Okay, so significant equals audit required. What if a component is not significant? tiny subsidiary, low risk.
Then usually analytical procedures are enough. You don't necessarily need a full separate audit for every single small part. That would be incredibly inefficient.
Right, saves time and money. Okay, so that brings us to the component auditor. Who are they?
The component auditor is simply another audit firm that does work on a specific component's financial information.
Like the folks auditing Lebanese shipping in Beirut.
Precisely. So Farhat Accounting in New York might engage, say, Lebanese auditing services to do that work. Their audit work then becomes evidence for the main group audit.
And can this component auditor be related to the GEP's firm?
Yes, they could be. It might be another office of the same big firm, like PwC New York using PwC Beirut.
Okay.
Or it could be a firm that's part of the same network. Or like in our example, it could be a totally separate, unrelated local firm.
Interesting. So if you're the GEP in New York and you're relying on Lebanese auditing services, how do you manage that? How do you trust their work given you're ultimately responsible? What's your due diligence?
That's really the core of it, isn't it? The GEP has some critical tasks. First, they have to understand the component auditor's independence. Are they truly objective?
Crucial.
And their professional competence. Do they actually know what they're doing? Do they have the expertise for that specific industry or component?
Makes sense. What else?
Second, the GEP needs to get a handle on how much work the component auditor plans to do. What's the scope of their involvement? Third, can they actually get the information needed for the consolidation? Is there going to be free access?
Potential roadblocks there.
Absolutely. And finally, the GEP needs to understand the whole regulatory environment the component auditor works in. Are they using IFRS while the parent uses GAAP? What are the local auditing standards?
So many variables.
And remember, even with all this reliance, the GEP is still the one overseeing the whole group audit, making sure it meets professional standards, deciding if the final report is appropriate.
So delegation, but not abdication of responsibility.
Exactly. You need a really deep understanding of the whole group, all its parts, their environments, to spot the significant components and make sure you gather enough good evidence.
It's a balancing act.
It really is.
So what if, despite all these efforts, the GEP just can't get enough evidence? Maybe a component auditor isn't cooperative, or there are restrictions.
Well, that's a serious problem. If you can't get sufficient appropriate audit evidence, you've got a few pretty stark options. If it's a new engagement, you should probably just decline it. Walk away before you start.
Okay. And if you're already in the middle of it?
Then you should try to withdraw. Just resign from the engagement.
Wow.
But sometimes withdrawal isn't possible, legally or practically. In that situation, the GEP has no choice but to issue a disclaimer of opinion.
A disclaimer? What does that mean for the company?
It's bad news. It basically means the auditor is saying, we couldn't get enough information to form any opinion. Not good, not bad, just we don't know.
Ouch. That sounds like a massive red flag for investors or lenders.
It is. It severely damages credibility. It's like a doctor saying, I can't tell you if you're sick or healthy because I couldn't run the tests.
Yikes. Okay, let's shift gears slightly. Documentation. With all these moving parts components, component auditors, what does the GEP team need to keep records of?
Oh, documentation is huge here. It's not just paperwork. It's the proof of the work done, the justification for decisions. It's critical for accountability.
So what kind of things need to be documented?
Well, you need an analysis of all the components, showing which ones were deemed significant and what kind of work was done on each audit, analytical procedures, etc.
Okay, a roadmap of the component.
Exactly. You also need records of any written communication between the group team and the component auditors about what was required.
The instructions, basically.
Right. And a list of components where you're actually going to reference the component auditor's report in your main group audit report. We'll get to that referencing decision in a bit.
Okay.
And finally, you need the actual financial statements of those components you're referencing, along with the audit reports issued by their auditors. It's about creating a clear, defensible audit trail.
Makes sense. So you mentioned referencing. Let's talk about the final audit report, the one the public sees. As the GEP, you have a choice, right?
Right.
About mentioning the component auditors.
Yes, there are basically two paths you can take regarding how you handle the work of component auditors in your report.
Okay. Path one.
Yeah.
No reference. What does that involve?
Choosing no reference means the component auditor's name doesn't appear anywhere in the group audit report. It looks like the GEP's firm did everything.
So the GEP takes full responsibility, visually at least.
Effectively, yes. But To do this, the GEP can't just blindly accept the component auditor's work. They need to be significantly involved themselves.
How involved?
That often means doing their own risk assessment for that component, performing additional audit procedures, maybe reviewing the component auditor's working papers and audit program in detail. You're assuming responsibility, so you need deep involvement.
So more work for the GEP, but it presents a unified front.
Exactly. It can look stronger to the market, perhaps, but it requires more effort from the GEP's team.
Okay, so what about path 2, actually referencing the component auditor? When would you do that, and what does it mean?
You'd choose to reference them, essentially dividing the responsibility in the report if a couple of conditions are met.
What are they?
First, the component auditor has to have performed their audit according to the right standards, GAAP or PCAOB standards for public companies.
And if they didn't?
Then the GEP has to do extra work to bridge that gap before they can rely on it, even if referenced. Second condition, the component auditor's report can't be restricted in its use. It needs to be something that could be provided if someone asked for it.
Okay, so acceptable standards and an unrestricted report. If you meet those, how does the reference look in the group report?
The report will clearly state that a specific component was audited by another auditor. It will usually mention the magnitude of that component's financials.
Like a percentage.
Exactly. Like, say, the component audited by other auditors represents 20% of total assets and 15% of total revenue.
Gives context to the shared responsibility.
Precisely. It will also mention the accounting framework used by the component auditor, like IFRS, and clarify that the GEP is responsible for any necessary adjustments, like converting IFRS figures to GAAP for the consolidation.
So it's very transparent about the division of work.
Yes, it clearly signals reliance on another expert for a specific piece.
Now, what if that component auditor's report isn't squeaky clean? What if it's modified or has an extra paragraph highlighting an issue?
Good point. If the component auditor issues anything other than a standard, clean opinion, the GEP has to use their professional judgment.
Judgment about what?
About whether that issue at the component level is significant enough to affect the overall group opinion. Should the group opinion also be modified? Or is it enough to add an emphasis of matter or other matter paragraph to the group report, basically flagging the issue without changing the main opinion?
So it depends on how material the component issue is to the whole group.
Exactly. It's all about the potential impact on the consolidated financial statements. A small issue in a small component might just warrant a mention, while a major issue in a significant component could lead to a modified group opinion.
Okay, let's make this really concrete. Can you give examples of how this referencing language actually looks in an audit report?
Sure. Let's take an AICPA report example where they reference another auditor. In the main opinion paragraph, you might read something like, in our opinion, based on our audit and the report of other auditors.
Okay, flags it right away.
Yeah. And then later it might say, we did not audit the financial statements of B company, whose report has been furnished to us.
Identifying the component.
Right. And our opinion, insofar as it relates to the amounts included for B company, is based solely on the report of the other auditors. And then it would likely give the magnitude. B company's statements reflect total assets constituting 18% and total revenues of 16%, etc.
Very clear. How about under PCAOB standards for public companies? Similar.
Similar concept, yes. The opinion section might mention reliance, but you'll often see more detail in the basis for opinion section.
Ah, okay.
That section might explicitly state something like, we believe that our audit and the report of the other auditor provide a reasonable basis for our opinion. It clearly lays out the foundation, including the reliance on the component auditor's work when applicable.
So slightly different structure, but the same principle of transparency about shared responsibility.
Exactly. Transparency is key.
Wow. What a journey through the nuts and bolts of auditing these big, complex groups. It really underscores the GEP's role, doesn't it? They're not just checking numbers. They're like an orchestra conductor, bringing together all these different parts from around the world.
That's a great analogy. They have to synthesize so much information, manage relationships, understand different environments, all to deliver one reliable opinion on the whole enterprise.
And the ultimate responsibility still rests with them, even when referencing others.
Absolutely. That point can't be stressed enough. Whether they reference or not, the GEP owns that final signature. It's all about ensuring the integrity of these consolidated reports for these huge global companies that really underpins so much of the economy.
Building trust, like you said.
Precisely, building trust in incredibly complex financial structures. As you think about all this, consider how these auditing hurdles might actually shape global business strategy.
Also,
Well, think about mergers and acquisitions, or even just how a company decides to structure its international operations. The complexity and cost of the group audit, dealing with different rules, finding competent component auditors, that all plays into those strategic decisions.
the audit isn't just an after-the-fact check. It influences the planning.
It has to, right?
Yeah.
The due diligence, the logistics of operating across different accounting and regulatory worlds. The audit process has to navigate all that. Understanding this gives you a much deeper appreciation for, well, the bedrock of global commerce.
That's a fascinating thought to end on. The audit as part of the strategic machinery.
Mm-hmm.
Okay, that wraps up this deep dive. We hope we've shed some light on group financial statements and the vital roles ensuring their integrity. Keep exploring these topics.
And remember, using structured resources can really help cement your understanding and connect these complex ideas.